Hello, welcome back to this week's market update. Today is Friday, January 12th, 2024, our first full market update of the new year. So we'll jump right in here. In this second week of 2024, equities rose slightly as spot Bitcoin ETFs made their entrance into the market. CPI data came in slightly hotter than expected, and another earnings season kicked off. As of close on Thursday, January 11th, the Nasdaq Composite rose 3.1%, the S&P 500 rose 1.8%, the Barclays Aggregate Bond Index rose 0.7%, and the Dow Jones Industrial Average rose just under 0.7% on the week. Heading right into this week's market updates, the SEC has finally approved a limited number of Bitcoin spot ETFs this week. So, started out the week with a hacked false SEC post on the platform X, coming straight from the Securities and Exchange Commission of the United States. So, this hacker posted that the SEC approved all Bitcoin ETFs on Tuesday afternoon this week here. But in fact, within an hour or two after that, the SEC immediately rejected this, said it was a hacker, and it actually ended up being a result of no two-factor authentication on their X account. So the SEC's account was not secure, they got hacked and falsely posted this. Then on Wednesday evening, we got the official announcement on the SEC website that a limited number, specifically 11, Bitcoin ETFs were going to be approved to be listed on Thursday. So here's the list of those ETFs, with the largest one being this Grayscale Bitcoin Trust that was traded over the counter previously. And really, the main differences, all of these will provide Bitcoin exposure to some extent, but the main differences lie in the fees as well as the volumes and the liquidity traded within them. But big update in the cryptocurrency world, in the alternative investment world, as the SEC finally approved spot Bitcoin ETFs. Moving along through this week's data, we got the December Consumer Price Index as well as the Producer Price Index here for the last month of 2023. On the headline inflation front, that ticked up a little bit faster than expected at 3.4% annual inflation in December, while core CPI fell from November at an annual rate of 3.9%. That was the first sub 4 reading in quite a while, so that was notable, but we did see a uptick in the rate of headline inflation. On a month-over-month basis, both headline and core CPI rose 0.3% in the month of December. Looking into the makeup of this month's CPI report, here you can see food at home, aka groceries, that was only up 1.3% from a year ago, so that's great that consumers are starting to feel lighter inflation at the grocery store. Food away from home, though, was up 5.2%. So that's pretty notable that the services industry, the restaurant industry, is still seeing quite a bit of inflationary pressure. And maybe this is a good sign that demand is still there for that. We also saw a decline in energy prices, as well as a decline in the prices of used cars and a very modest increase in the prices of new vehicles. So, notable things there. And then finally, the cost of shelter is up 6.2% from a year ago. So, this was slightly slower than last month's 6.5% inflation rate in the category of shelter. Just a few things we want to note as we look through the inflationary data. Alongside that CPI reading, we also got the PPI, the Producer Price Index, for the month of December, and that showed an annual inflation rate of just 1% to producers on a headline basis, and then a core inflation rate of 2.5%, which excludes food and energy prices. It actually fell on a month-over-month basis on that headline number, fell 0.1%, while the core inflation rate of PPI rose just 0.2% in the month of December. Kind of behind that, though, we saw decreases in the cost of foods to producers, cost of energy for producers, the cost of trade for producers, the cost of transportation and warehousing. And then the only main increase we saw in this PPI report on a month-over-month basis was this category of other services. So that engulfs quite a few things there, but that did increase on a 0.4% month-over-month basis. One final update as we end our week on the consumer credit front following that mixed inflationary data is the November consumer credit report that we get from the Fed. So that showed an annual increase of consumer credit, aka debt, of 5.7% from a year ago, and that was largely led by revolving consumer credit. That includes things like credit cards, personal lines of credit, things that consumers tend to use when they're in more of a pinch for cash. So that is quite a substantial increase in consumer credit. But it was also the holiday season, right? So maybe people are kind of loading up on their credit cards as they're getting gifts, as they're going spending, they're shopping, they're eating out, those sorts of things for the holiday season. On the other hand, we saw non-revolving credit, which is those bigger ticket items, think cars, think large educational purchases, those sorts of things rose only 1.5% from a year ago. So that was actually less than the rate of inflation in the same time period. Here you can see just kind of where revolving credit is over the last 20 years or so, how obviously we've been in an uptrend of the use of revolving credit, but where are we moving next? So is it going to continue to keep rising here? You can see ever since the stimulus kind of dried up, we've been rising in the amount of consumer credit that consumers are holding on to on credit cards, on personal lines of credit, those sorts of things. But is it going to continue to rise? Is it going to start to turn over? We're not sure. So this is just really interesting to see as we track alongside the economy and see how consumers are doing. So thank you for joining us for our market update this week, and we look forward to providing another update next week.